Hello, investors, and welcome to the weekly market report. I'm Magee, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. As I do each and every week, I've left my lines on the chart from the previous forecast so you can see how things worked out. And if you recall last week, I said we'd move just a little bit higher. I was not too bullish at that particular point in time because of the candles that were showing up on lower volume down here. But we came very close and almost pivoted on the exact day. We were one day after that, where yesterday we hit a slightly higher high. And today, as I zoom in here, you can see that that is a bearish harami. That's when you have a small-bodied red candle that falls within the green body from the previous day. And in addition to that, if you look down below, we have an increase in volume on that day. Now, I was pointing this out to our market rebels earlier today that if you, again, take a step back here and you look at the stochastics and the CCI and how they work, down here you can see that when the CCI, which is the blue line, crosses the red is the sell signal, that's the plus 100 mark. We generally get a crossing sell signal right around the same area of the stochastics, and that's when these lines are crossing here. And you go straight up, you can see that when that happens, we generally sell off. You see, here's another cross here in this area. We had a cross, and it's right, almost right exactly at that high. Here was another sell signal that took place right there. Again, very close proximity to the stochastics crossing with a sell signal, and the same thing, crossing below, sell signal here, another top. Well, here we go again. History is repeating itself with the sell signal there. And now, today, the CCI crossed below with another sell signal. The stochastics has not yet crossed, but that's where that leaves us off here with the forecast. I'm leaving this downside target on the diamonds right there at 324.54 until next week. That's not moving. And if you look again, that's very close to where that 20-period moving average is right there. There's also a very slight gap below the market that matches up with that moving average. And 80% of the time, gaps fill. If you've been following along, not only do we have the oscillators that work very well as indicators, but those are conditions or circumstances where we have a wide divergence from that moving average. We generally get pullbacks to the moving average. So that's my forecast on the diamonds, not budging at all from last week's target. Now, if we look at the Qs, we're seeing something very similar. Of course, we have the CCI down below. I'm starting from the bottom and going up. We have the CCI down here is crossing with the sell signal. And the hinge that I refer to quite often is when the stochastics, that K line starts going from an upward direction, starts curving over. Again, we see that most often when the markets are reaching tops. See how the stochastics is rolling over here, later followed by the sell signals in confirmation in some of the other oscillators. By the way, the CCI is my favorite oscillator. It generally leads the stochastics by about 1 or 2 days. And so I rely heavily on that for my option trading and forecasting. And if you go back to any of the weeks over the many years I've been doing this, you'll see I often refer to the oscillators, and almost always. So that is something to consider if you've never been exposed to the CCI or the slow stochastics. I would suggest you read up a little bit about that. Now, one other thing with regard to my forecasting into next week, the momentum is shifting, and we have another, I'll expand that there, we have another bearish harami. I said last week we would most likely bump our heads against this resistance because it was a role reversal. Remember, I drew this as former support. Once broken here, we'll often revert back to a resistance or reverse the role as resistance. And so that's what we're up against right now. So we have bearish signals there. We have bearish signals on the stochastics and also on the CCI. So I'm going to make a conservative call to the downside on this because, again, like the diamonds, we have a gap fill to the lower level right there. So my target for next week is 300.12. So it's $300.12. And that is for the Qs. You know, before I go on to the VIX, let me just throw this out there. This September, from 21st to 24th in Dallas, Texas, I'll be joining the entire Market Rebellion team for RebelCon 2022. If you are interested in signing up for that and joining us out there in Dallas, then just go to marketrebellion.com/Dallas. I'll put that link in the bottom underneath the description box. We'll have, like I said, John and Pete and Nigerian, along with the entire Market Rebellion team, is going to be there, along with some surprise guests. I'm not going to disclose that right now, but I'm sure you're not going to be disappointed seeing some of these folks that are going to be showing up in Dallas with us. So with that, again, go to marketrebellion.com/Dallas. Now let's go right to the VIX. The Volatility Index is an oscillating indicator. It's something that does not trend like a stock. And as a result, it becomes far easier to forecast the VIX than an individual stock or equity or even a currency for that matter. But last week, I said we would most likely go down, hit 2506. We did that yesterday. You see that? And then went a little bit further. Today, we closed with an inverted hammer. Now, there's a lot going on here. We have this inverted hammer, which is a bullish sign. When you see an inverted hammer like that at the end of a downward stretch here, you generally see prices that move up after that. Now, in addition to that, we have 1, 2, 3, 4, 5, 6, 7 red candles in a row. That is one of the longest stretches of red we've had in a long time. Therefore, there's a greater chance that next week we're going to see some green. Now, if you look down below, you'll see that the CCI is just about to cross with a buy signal. Now, remember, the VIX, for the most part, is inversely related to the S&P. So if I believe that the VIX is going to go up, like I think it will, then the S&P will most likely drop. So I'm going to make a forecast on the VIX being, again, fairly conservative with that, with a VIX up to 2732. 2732. Look at the bottom right of that little data box. You'll see that that's right around the Fed announcement here and what they're going to be doing with interest rates, but that's right around June 9th. So that's going to be interesting to see as the Fed comes out and, well, what is the Fed going to do? I don't even think the Fed knows what they're doing at this point. They're far behind the curve, and I'm going to talk about that in a little bit. But the VIX being as bullish as it is right here, again, if you're long anything in the general markets, I would use good risk management disciplines there and keep your stops in place. For our option traders, they're absolutely looking forward to this VIX rallying because we have what's called put spreads on. So we will make money on the way down with what's called negative delta spreads. Negative delta are bearish spreads that we've been working for a good long time, and our option traders are having a field day right now. If you're interested in learning how to trade options, again, go down to the description box and you'll see all the links to get you involved right there. So with the VIX being a leading indicator, let's take a look at the SPY, which again is inversely related to the VIX. And you'll see that we came close to my pivot target up here, but the pivot is coming a little bit earlier than I forecasted, which is okay because, again, we're negative delta, remember? So this is a bearish harami as well, bearish sign. We see the oscillators starting to hinge lower. Again, as I magnify that, we have a sell signal on the CCI. So as a result, I'm keeping that downside target on the SPY at 405.07. It's a longer term forecast to hit that target. I think we might hit that a little bit sooner than expected, but again, that's okay. We have a very slight gap here that was not filled. We came close, but I think we're about a penny away from filling that gap. And so everything right across the board so far is looking short-term bearish. If you look at IWM right here, you can see that same story repeating over and over again. I said there was a chance we might go over this resistance, and we did that. And the next resistance, again, as I identified last week, was 194.02. We did not hit that. In fact, it's turning back from this whole resistance area, forming, again, another roll reversal point where former support back here is turning into resistance. So with all the bearish signals, I'm forecasting lower on IWM. Right here, I'm going to call that right back to the moving average, just like that. And so that is 179.07, 179.07 for the forecast moving forward. Again, look at that. We're right at that cross right there at the red line, and a full cross below that will generate the sell signal. And so that is for IWM. Notice down below here, We do have a very slight gap. That's interesting how it matches very closely to my forecast right there. So that is it. We have the diamonds, the Qs, the VIX, the spiders, and IWM. Finally, I said I was going to mention the Fed. Well, take a look at this. The Federal Reserve puts out this report here, and you can see that the dark blue line, let me draw some crayon marks on here. The dark blue line peaked out right before the presidential elections. That is the credit that basically Americans were carrying up until that point. And then we saw a dramatic drop in credit debt. At the same time, we had peak savings showing up. Again, right before the presidential election there, peak savings. And then what happened? COVID hit, right? The COVID crash. And so people started spending their money to survive through the COVID lockdowns. And shortly thereafter, what happened? They ran out of cash, and then they started using credit. And look where we are now. This is an alarming number that we're seeing right here with regard to outstanding debt on revolving credit. And these lows back here are the lowest we've had in many years. So what's happening? Personal savings are being depleted quite rapidly while debt is going up. Now, the Fed, I believe, is focusing more on preventing a recession than they are in stopping the inflation. But I think that's a big mistake. And now, I'm not an economist, and I'm not going to go out and try to have a debate on that level. But I do remember from history Paul Volcker. And if you remember what Paul Volcker did at the time as chair of the Federal Reserve, he aggressively attacked inflation, raising rates, and eventually put it into check. Right now, again, I believe the Fed is far behind this curve. They're not raising rates faster, or at least enough to head off inflation, which is still ramping forward. If you're looking at oil prices, today we went well over $120 a barrel. I believe we're going to go up to $140 a barrel by the end of the summer. That, as you may have heard, is baking its way into the economy. And as people are pinching pennies because they're running out of buying power, here's another look of what the personal savings rate looks like. That is what leads us into a recession, possibly even a great recession or worse. I know this sounds dire, and I know it sounds like, oh, the sky is falling and all that. But I'm telling you, folks, my long-term forecasts of the last 40 years, I've never been wrong. Not on one long-term forecast. Short-term forecast, sure, you follow me week to week. Every now and then I'm missing on a forecast on a major market. But the longer-term overall big picture trends, I've never missed those forecasts. And I think that if you're not focusing on what could possibly happen moving forward, then you're going to be one of the victims. I tell people all the time, what I'm doing, I keep buying silver, I keep buying gold, I keep planning for inflation. If I'm wrong, and there's a possibility that could happen, that I'm wrong about inflation, but if I'm wrong, I'm no worse off than what I was before my planning stages. So this is something to really consider, because if you look at the numbers, they don't lie. You could turn on some of these financial programs and everyone's thinking, oh yeah, we're going to go higher. But the fact is, go talk to your neighbor. Go talk to some of the parents who are cutting back on driving their kids to summer practice for the summer break because they don't have enough money to put in the gas tank. It's hitting a lot of people. And again, that sounds negative. It sounds, it's like, this dark cloud coming over us. But remember, when you're trading the markets, you can make money on the way down. You just have to take the time to learn about that. You make money on the way down by shorting the market if that's one of your strategies. You can learn conservative option strategies. You can learn how to manage risk. And if I take a step back and look at this monthly chart, going back as far as we can go, if we come all the way back down to the March 2020 lows, like I think we could, you could be making money all the way down as this market zigzags to those lower levels. And then when do we stop taking short positions, or when do we stop with negative delta option positions? You stop when the trend stops going down and reverses and goes back up. On the call that I had with our market rebels today, I mentioned the book. It's Technical Analysis of Stock Trends by Edwards and Magee. It was the second book I ever bought back in the 80s to learn about stocks and trends and charting. I don't get paid any bit of money from their publisher. in selling books. That's not what I'm getting at here. I'll leave a link to that in the description box. Again, it's about 400 pages. You don't have to read it, all in one night. You're not going to do that anyway. It certainly doesn't read like Gone with the Wind, but it's a textbook that you can learn from, learn how to recognize trends, learn how to profit from those trends, and learn how to manage risk when those trends reverse. So with that, you have a great weekend. We'll talk to you soon. So long.